Markets go up, markets go down, and people freak out every time because their money's involved. Today, we'll talk about how to understand why it goes up and why it goes down, and to stay steady during those times so that you are able to make the best use of your money and build your investments and build your wealth. Today's episode is about market cycles and how you can learn how to ride the ups and downs just by having a little knowledge of how the system works. So let's talk about four main reasons why the market moves either up or down. So number one is interest rates. When interest rates are high, it slows growth, so the market drops. When the interest rates are low, it stimulates growth, so the market rises. Number two is inflation. High inflation is unpredictable and it's scary for people, so that tends to make the market go down. Lower inflation tends to pacify people and allow them to feel some stability when making investments, particularly on the business end, so the market tends to rise. Number three is corporate earnings. So those big evil corporations, the ones that are making all the money, when their profits are up, the economy tends to follow it. But when the markets go down, the corporate earnings go down, the market tends to follow it also. Number four are global events. So things like a pandemic, which we're really familiar with, wars or elections tend to have significant impacts on the market, but they tend to be short-term duration, right? Less than a year or two, and then the market has always corrected itself afterwards. So if we think of an analogy for us, the fuel, oxygen, and heat affects how the fire grows, right? These same inputs we talked about affects how the market grows, either growing or shrinking. Let's talk about market cycles. So for market cycles, we have the bull market where things are going up. You'll have corrections where they kind of drop back down to a level they should be at. A bear market where things are dropping off even more than that, and then the recovery, which always follows that. It's important to note that during every one of these corrections, every time the market has dropped off, from the Great Depression, from the 2008 housing market crash, the dot-com bubble, the pandemic in 2019, the inflation crisis, all of these different things, every single time the economy has recovered from this. The main point to take away from this is that the US economy's average growth over the past 100 years is 7 to 10%. So the problem is not these dips themselves. The problem is the actual panic selling during these dips that affects people. So the market has cycles, right? But following this with an emotional roller coaster is the absolute worst thing you can do. So things like this would be panic selling of things because things are dropping off, panic buying of things because, oh, I don't want to miss out. The fear of missing out itself is, well, other people are doing this, I have to drop in at that same time. All these things are emotional reactions to things that are happening because people are connected to their money and they're worried about going hungry or not having something for their future. That's why people freak out and then end up selling these things during these different cycles. But if you understand it and you're looking at it from a long-term perspective and saying, hey, I plan on having this money 10, 15, 20, 30 years from now, resisting the urge to do this will protect you against yourself. So it's important to mention here the term groupthink. We see the same kind of thing happen at the firehouse, and it's the same kind of thing that happened with investors. You tend to run with the group because you're scared of being left out of it, right? So the downside about this is that when the groupthink is saying, hey, oh my gosh, things are hot right now, I have to buy, more people jump into that, and then eventually that's going to have a correction, it'll go down. Or, oh my gosh, I'm freaked out because things are dropping off, I want to sell. If you do the same thing, you end up being in the same kind of poor situation. The best investors tend to be the quiet, boring investors that just do things consistently over a long period of time. And the consistency is going to beat out the timing of that the majority of the time. The best people who invest and who are able to time the market are completely disconnected from the emotional part of it. And they are very analytical about what they're doing, for how they're predicting how the timing is going to drop off. Very difficult for amateurs or just normal people to do that. That's why dollar cost averaging is so advantageous and tends to work out best for most folks. So we'll zoom in here and take a look at a brief little picture, and we'll just show how the zoom out actually affects your perspective on it, right? If you're looking at a small section of the economy in a small area, you'll see a bunch of jagged lines that scare you. Hey, there's ups, there's downs. But if you zoom out from a much bigger period of time, you'll see that the scale of the line itself is really just trending one direction, and that's up. That's where that 7 to 10% return for the US economy comes from. So if we take a look at an example and we say that we have a 10-year period of investing, if you miss the 10 of these biggest growth days, you could cut your investments down in half. Over that same 10-year period, if you missed 20 of the best growth days, you could have no returns or almost a negative return as a result of it also. That's why dollar cost averaging or the automatic investing is so much more powerful than trying to time the market or letting emotion guide you into those decisions that you're making. Main point to take away from this is staying invested beats timing the market every single time. Let's look at 4 different things you can focus on when you're trying to protect yourself against market cycles. So the number one thing you can do to protect yourself against market cycles is dollar cost averaging. Previous episode, we covered this in more detail, but basically purchase the same amount of, or the same, invest the same amount of money consistently over either every 2-week period or every month period, and continue to do that over the long term. Number 2 is diversification. So we've talked about this in several different episodes, but having diversification with growth stocks, having some dividend stocks, REITs or real estate investment trusts, or actual real estate itself, and then some of those S&P 500 index funds. Don't invest all of your things or put all your eggs into one basket. Have a diversified portfolio of those different investments that you make. Another simple way to do this, if you're looking at your 457, is just having a target-based fund. So if you have a target-based fund, and let's say it's 2025 now, if you're retiring 30 years from now, a target-based fund of 2055 would basically split up that diversification for you. It's going to have a mix of stocks and bonds and growth in there, so that you're not having to worry about plugging those things up individually. Number 3 is rebalancing. So if we're looking at it from a brokerage account standpoint, and you have diversified you have a diversified portfolio through either ETFs, you have dividend stocks, let's say you have some REITs, things like that. Find what percentage of those mixes that you want in that account, and then every year take a look at what your percentages are and see if they line up with that particular philosophy that you're going with. You may have to readjust what it is to make sure your percentages are staying the same. The 4th thing to do is don't try to time the market. Professionals don't get it right a lot of the time. So for an amateur, it's very unlikely that you'd be able to do it in the same way. Stick with dollar cost averaging and don't try to time it. So let's look at this from a mind shift perspective. The market itself is not your enemy. Your emotions are. If you look at volatility as a threat, you'll lose. If you look at volatility more like the weather, then you'll change your mind to say, hey, I'm just going to weather out the storm. There's always going to be another sunny day after this. So market dips aren't a danger of investing. They're part of it. It's going to happen every single time. Every time there's ups, there will be downs, but generally there will be growth over the long term. So if you look at it from a long-term perspective and not the immediate zoomed in feature of it, you'll do much better for yourself and for your family for building wealth. Download the quick guide in the description below. Thanks for joining me on Finance for Firefighters. Thumbs up if you like it. Any comments below. Hope you guys have a good shift. I'll see you in the next one.